Right, good morning everyone. Welcome to our webinar on how to MiFID-proof your business. My name is Alex Cole. I'm Business Development Manager here at 7IM, and today I'm joined by Verona Smith, Head of Platform, and David Ogden, Head of Compliance.
Thank you, Alex.
Thank you, Alex. Morning.
Morning.
Just a couple of housekeeping pieces before we start. On your screen now you should be seeing our first slide on how to MiFID-proof your business. Just to the right of that, there will be a question and answer window there for you. If you do have any questions throughout the webinar, please do ask them in there. And if they're relevant to the slides that we're on, we'll try and answer them straight away. If they're a bit more generic, we'll wait till the end of the presentation and try and answer them then. If for any reason we can't answer questions during the webinar, we will follow them up after the webinar's finished via email or over the phone if that's more applicable. Also, there will be more information on our website following as we get the information from the governing bodies that be. But without further ado, let me pass you over to Verona and David.
Thank you, Alex. Okay, so how to MiFID-proof your business. Let's get into the details. So, David, who does MiFID actually impact?
Well, MiFID impacts pretty much everybody who has any interaction with the regulated markets. So every investment firm is impacted by MiFID, some more than less, but it certainly applies to 7IM. It certainly applies to our advisor partners, and it very definitely applies to our underlying clients, and they will see different impacts at different levels, but the application is to everyone who transacts business on a recognised stock exchange.
Fantastic. So what we're really saying here is that this MiFID party, everybody's invited, no one's left out.
Yeah, MiFID's been called lots of things over the years. That's the first time I've heard it described as a party, but let's stick with that for now. But yeah, everyone's involved. I should say just before I really get going that my principle when we look at things like financial promotions adverts is that they've got to be clear, fair and not misleading. The fact we've called this how to MiFID-proof your business is worrying me slightly because I'm not sure we can guarantee that. So let's hope I've not broken any rules there.
I'll report that to the FCA.
Thanks for that.
Fantastic. Okay, so MiFID's affecting everybody, so let's actually have a really brief little history of MiFID and talk me through the objectives. Why is everybody invited to this MiFID party?
Yeah, well, we need to go back a little bit in history, I think, not too far, but 2007, so 10 years ago, and I think it was a wise man, I forget the name, but he said if we fail to learn from history, we're doomed to continue making the same mistakes. So that was MiFID I, and here we are at MiFID II, and I wouldn't guarantee MiFID III wouldn't be along sometime in the future. But we go back 10 years, and 2007 was the key, and the objectives there at the bottom were the objectives of MiFID I. It wasn't called MiFID I at the time, we didn't know there was going to be a sequel, but it applies equally to MiFID II. So market efficiency, market probity, and transparency for everybody in the market is the overriding objective of both of the directives, MiFID I and MiFID II.
Fantastic. So are we really saying that the market isn't efficient and the market isn't, operating the way it should?
Well, I think it operates reasonably, but no one can ever pretend that markets are perfect. That is probably a scenario we'd all like to aim for, probably unachievable, but there are little steps we can take towards getting to that happy situation. And we should really point out, when MiFID I came in 2007, I'm sure you all probably remember 2008 and 2009 were a little bit on the rocky side, to put it mildly. And they changed the nature of financial markets quite significantly. In particular, the banks who had been at the forefront of the financial crisis had all sorts of new regulations placed on them, restrictions on the use of their capital. And what happened really was that the market became very fragmented. Things like dark pools emerged, and there were many, many more participants. So MiFID I quickly became obsolete. And MiFID II has come to try to tidy up the impact of MiFID I not quite achieving what was intended.
Fantastic. Okay, so we're all looking forward to MiFID II. When does the party start with MiFID II?
Well, officially the 3rd of January 2018, which is the first trading day of the new year. And bearing in mind, of course, that MiFID II was meant to be launched on the first trading day of 2017. So the party's already running a little bit late. But we've now got 9 months before the rules come in. There are still some things to clarify, as we'll cover later. I would say there is no chance of it being delayed further.
Okay, so we've still got 9 months. Now, we know that we can all do a lot in 9 months, especially women. So are we going to be able to get everything done in 9 months?
I'd like to think so, but I'm not in the business of guaranteeing things that I'm not in control of. And there are a lot of things to cover that we may or may not get addressed. I would expect some regulatory flexibility, but that's not the sort of thing you anticipate too keenly unless you're very, very confident. So there are things that will be outstanding. Hopefully most of them will get clarity over the next few months.
Okay, so summary there is that it's happening, we're all invited, we've got 9 months to get ready, and now we've got to get into the detail of what that actually means we need to get ready.
Yeah, absolutely. If we relate it back to the party, this isn't the sort of thing where you can just throw together a few crisps and nibbles and a glass of fizz. This is going to take a little bit more work than is involved in that. There is a lot of work to do, and some of it involves system development, and we all know that system development is an issue which does tend to take a little bit of time.
Okay, so let's get into the detail of this. So talk me through what's going to change. What do we need to do?
Okay. Well, the first subject we're going to look at is transaction reporting. And this applies if you're executing any transaction in any listed security. So worth making the point now, this doesn't apply to authorised funds that are not listed, but it does apply to any other transaction in a security that is listed. So that would include ETFs, model investment trusts, listed shares, derivatives, anything that's listed on a stock exchange.
Okay. So if I'm in a model portfolio and I've got some normal funds in there and I've also got a couple of ETFs, it'll only apply to the ETFs in the model portfolio. It will not apply to the funds I hold.
Correct. But in practical terms, the end clients and the advisors won't see any great difference in that because we'll need the same type of data for the clients regardless of whether we have to report it for particular transactions.
Okay. So the whole point of this transaction reporting is actually for us being the platform, to provide to the FCA a whole lot of data points to do with specific trades. Today we already provide a whole lot of information. I think it's about 24 different data points we provide.
Yeah, that's right. And transaction reporting is not new, but what is new is that the regulator wants much more detail. And if we put that in its simplest form, the detail it wants is who is initiating a transaction, who's benefiting from the transaction, and who's actually executing that transaction in the market, which sounds relatively straightforward, but if we bear in mind that a current transaction report under the regulations that exist today involves sending 24 data items to the regulator, the new rules involve sending 65 data items to the regulator. So a huge increase in the granularity of the data that's being requested. Okay,
so, and that's us, as I said, as the platform provider, we're now going to have to provide for every single one of these trades 65 data points.
Not all 65 will apply to every trade, but certainly in some trades, yes, 65 data points.
And then that begs the question, where are we going to get this information from?
Yeah, of course, our role is to pass the data to the appropriate recipient, which is the regulator, but we can only do that if we have the data, and that's where we'll be looking for some help from our partners, many of whom are on the phone.
Fantastic. So can we get into a little bit of detail about what are the additional data that we'll be looking to collect and to provide to the FCA?
Yeah, a lot of it is internal. We won't need to bother our clients and partners for much of it. So I think it's probably best we focus on the issues that we are not in control of. Some of the data that our clients will certainly have and advisors will certainly have. And in some cases we don't have it all at the moment, so we'll be looking for additional data from yourselves.
Okay, so let's get into a little bit of detail about what this additional data could look like.
Okay, we need to break this into a number of different categories. So the first one being natural persons. So clients who are Mr. or Mrs. Miggins, they need to be identified to the regulator when a transaction is transacted on their behalf on the stock exchange. And happily, this is not too demanding from a data collection point of view, because natural persons, in the vast majority of cases, already have the standard identifier, that is the national insurance number. And we hold that national insurance number for the vast majority of our clients for lots of reasons. We often need them for ISAs, for identification purposes, for taxation, reporting, etc., etc. So we think we have that data for well over 95% of our clients. We will need to try and get it for the outstanding ones, but that's a fairly small number.
Okay, so that could be an additional piece of information that we will come back to advisors and request.
Indeed.
For the clients that we don't currently hold their national insurance number for.
Yeah. And there are some alternatives for that very small population of people who don't have a national insurance number. They involve using passports, national IDs, etc., etc. But hopefully we can get national insurance numbers for pretty close to 100% of the client base.
Okay, so here we are. Step one of MiFID is actually to report to the FCA, so the FCA has got it down pat who the person is that's actually benefiting from the investment.
Yeah, and what the FCA is trying to achieve here is that they can research examples where the market clearly hasn't operated in the way everyone would wish. Examples would be, say, a takeover bid is announced and the share price has jumped the day before, or in reverse, a profit warning, that sort of thing. I think we all know that happens fairly extensively, and the regulator simply doesn't have the tools to identify who it is that's behind those trades at the moment. So their objective is to be very clear who is benefiting from those trades and who is initiating them.
Okay, so this is all for natural people. Unnatural people, is there such a thing?
Yeah, most of them work in compliance, unnatural people, but that's just the way it is. Non-personal accounts are what Verona refers to as unnatural people, and that covers things like corporates, charities, trusts, anything that's not a natural person. And this is more complicated. It's a smaller universe of people because most of our clients, and I would imagine most advisors' clients, are people, but clearly we deal with non-personal entities as well. And they have to be identified in the same way that natural persons have to be identified, but the fly in the ointment there is that those types of clients clearly don't have a national insurance number and don't really have any current standard identification that can be used for that purpose.
But there must be a solution for these kind of accounts.
There is a solution. Some people would describe it as the ideal solution, some people would defer. The solution is called a legal entity identifier, or an LEI for short, and essentially any non-personal account which wishes to transact securities on a regulated market beyond the end of this year will need to get an LEI, and if they haven't got one on the 3rd of January, we will not be able to transact business for them. Just worth stressing that doesn't cover authorised funds, so if it's clear that a client only wishes to go into authorised funds and that's the appropriate thing for them to do, this is a non-issue. We have some technical issues in making sure we can cover that, but that's our problem, not yours. But apart from those exceptions, these types of clients will need to obtain an LEI.
Okay, so how this will work in practice, if you, for example, are transacting business on the platform, it's for a non-personal account, we have an LEI, then they'll be able to basically transact business as usual, buy what they want, ETFs, anything. Yeah. If we don't hold an LEI for that particular account, we will not be able to transact any listed securities for that account. Normal managed funds collectives will go through as they normally would, but if, for example, they're in a model portfolio that had an ETF, we would not be able to transact that. So it's really important that we get these LEIs. Now, how do we go about getting LEIs?
Okay, LEI is a global code. Applies. You can only have one for each entity, because it has to be unique to that entity. And there are 40 organisations around the world that are authorised to issue LEIs. Of those 40, there is only one in the UK, and that's a firm called Univista, which is an offshoot of the London Stock Exchange. So everyone is free to go to any of the 40 around the world. I suspect most people who want to do it domestically. So Univista will be the firm that is issuing LEIs for everyone that needs one and applies for one.
Okay, and are they doing this for free?
Not many things in life are free, and this is not one that's going to be added to the list. They do cost. The initial cost to get one is £115 plus VAT, and that's the start of the news. The other news is they must be maintained. These are not codes for life like a national insurance number. They have to be confirmed every year, and that costs another £85 plus VAT. And there is a maintenance requirement, so if there are changes in addresses, directors, authorised persons for these entities, then they need to be updated during that process. So if we have one on the 3rd of January, it needs to be updated before the 3rd of January 2019, otherwise it will expire and die and cease to be useful, and we'll be back to the situation where we can't transact market securities.
Okay, so just so I've got this right, for these non-personal accounts, we need to get an LEI if they plan on transacting in listed securities. That's got to be paid for by the client, and it's not only a one-off payment, there's an ongoing £85 plus that they must pay to keep these up to date.
That's right. And the other point I'd make is that Univista, as we said, is the only firm, the only business in the UK that can issue these. There are many, many thousands of entities that are going to need these codes. If they all apply in December, I suspect it might not go terribly well.
Sounds like they're going to be very busy.
I think they are, yeah. And it's also worth pointing out, Univista do this on a cost basis. It's not going to be a huge profit centre for the LSE, so don't go out and buy shares in the LSE on the back of this.
Good point. David, we've had a question come in. Do SIP clients qualify as natural persons in respect of the identifier number?
I love it when a question comes in that I can give good news to, because yes, they do. Although clearly the legal client is the SIP manager, we look through to the beneficial owner. The regulations allow us to look through to the beneficial owner, so Mr. Smith's SIP, the code will be Mr. Smith's national insurance number.
Okay, great. So there's no additional codes or anything that we have to worry about then. Fantastic. So are we expecting, well, we are hoping that to be able to facilitate this, we're going to start receiving the LEIs for all these underlying non-personal accounts?
We'd like to get them the sooner the better. There is system development work, as you can imagine, on here. We can't just get a code and send it on a bit of paper. When we execute a transaction, it needs to go through to our clearing agent, Pershing, so that they can actually do the report, and it needs to go through in a format and in a place that they be able to recognise and pick it up without manual intervention.
Fantastic. We've had another question on these LEIs. Can we, being the advisor, apply for LEIs for clients, or will the client need to do this directly themselves?
It is possible to apply on behalf of someone, but you must have written authority to do so.
Okay. So the application process can be undertaken by the advisor.
Yeah, it can be undertaken by anyone who's given the authority by that client.
Fantastic. Brilliant. Okay, so between national insurance numbers and LEIs, we're able to identify the client. Next step then that we need to report to the FCA is in regards to who's actually instructing and who's the person making the decision on the trade.
That's right. If we backtrack a moment or two, we said there were three particular elements of information the regulator's looking for. So who's the beneficial owner, who's executing the transaction in the market, which in our case would be 7IM, and who's actually who's making the decision to execute that transaction. Now, for an execution only or an advisory portfolio, by definition, the person making the decision must be the client, because they're making that final call. But for a discretionary manager, that clearly isn't the case. It won't be the client that makes that decision. They've delegated that authority to the manager. And this is one of the areas where we're really not quite sure yet. We will need to get an LEI for the firm or a national insurance number for the individual that's making the decision. Now, my impression is that most firms would have some sort of committee structure for investment management if they hold discretionary permissions, and it would make much more logical sense for me for the LEI of the firm to be the data provided rather than the individual manager who's made a decision. But that's one of the areas that we need to get clarity on, and various trade bodies are working towards trying to establish that with the regulator.
Mm-hmm. And does this apply for advisors that are basically building a portfolio or holdings for a client, but not under discretionary permissions?
If it's not under discretionary permissions, then I think by definition the decision maker must be the client.
Okay.
They're advised and they agree to go ahead.
Okay, so they're the ones, even though the advisor's putting the recommendation forward, it's the client that is actually saying, no, I want to follow that recommendation, so it's the client.
Yes.
Fantastic. We've had another question just on the LEIs, popular subject. Would a SAS need an LEI?
I think that's one I might have to park for a little bit later.
Okay.
My educated guess, hopefully slightly more than a guess, is that it will, because there isn't a natural person that we can look through there. It would be the actual scheme itself, but that's one. If I could take that away and clarify that later, I shall do that. When I say clarify later, I don't really mean by lunchtime, because I think this is one of the areas that is just not 100% clear yet, but we will clarify it as soon as we can.
Fantastic. Okay, so to recap, we've got an identifier, we know who's actually the underlying person, and we know who is instructing the trade on behalf of the person. So we're reporting that all up to the FCA.
Yep.
Fantastic. So, reporting back to clients.
Yeah, moving on to the next subject, client reporting. And by client reporting, what we mean are the periodic statements in regulatory terminology, valuations in most people's lingo. So not contract notes, client review reports, any of that sort of thing. These are the formal regulatory periodic statements that contain details of portfolio, fees, dividends, income, cash movements, etc., etc. And at the moment, they must be sent every 6 months to a retail client, but that retail client has to be given the option of receiving them quarterly if they so wish.
And the way that we facilitate on the platform is that when you set a client up, the advisor would elect whether these valuation statements are going to be sent out 6 monthly or quarterly. And what's interesting is that most firms opt to do 6 monthly. Is that going to be a problem?
Yes, it is. So a moment ago I said I'd like being the bearer of good news, but that moment's past now. There is now no option. All retail clients must get full quarterly periodic statements. So the option of having them every 6 months or more frequently, if the client really wants that, has gone. They must get them every quarter now.
Okay, I can hear the cheering in the streets for this one. Fantastic. So this is sending out the statement information. To stop us having to basically go and, plant a forest every time we do this, is it okay for these to be delivered electronically?
It is. There are some challenging elements, but it is absolutely possible within the rules now and going forward. To deliver a periodic statement electronically, it has to meet the definition of a durable medium, which is one of those little regulatory words we all use in common everyday language. A durable medium essentially means something that can't be changed. So you can't send someone a spreadsheet or a Word document. You can send them a document which is fixed and can't be altered along the way, which I think is probably quite a logical thing to require. And they can be delivered electronically, but that's not quite the end of the story, because we, as the dispatcher of those periodic statements, must be able to demonstrate that the client has opened them. And if we can't demonstrate that, then a month later we will have to send a paper report anyway.
Okay, so if I've got this right, I'm the client, I'm a bit of a greenie, I want to receive everything electronically. I get an email through to notify me that I can actually log on and see my statement, because obviously we cannot email out the statements because it's non-secure. So if I do not have time within a month, because I'm really busy, to log in and to have a look at my statement, then 7IM as the platform provider will be sending me a paper statement. Is that right?
That's right. That's a facility we have at the moment. It's not a sort of regulatory requirement in the same way that it will be post the end of this year, but that's exactly what will happen.
Okay. Key point on this, for those clients that do wish to receive it electronically, will obviously need their email addresses.
Yeah, absolutely. The more we can get, the better, really, because I'm sure most people, certainly not all, but I would imagine most people would prefer to see these online in the age which we live. So that's something we will ask for advisors' help on if we can in getting as many current validated emails as we possibly can.
Okay, and then once we've got the email address, then it is encouragement to the client to actually go in every time they get the email notification and take a look at their statement.
And we might end up sending reminder emails. It's possible to try to avoid sending paper copies if at all possible, but clearly we're not going to get 100% on that. It's an unlikely scenario.
Okay, fantastic. So that's the impact of reporting onto investors. The next one.
Just to mention on that one, there was one other one on custodian statements. I'm sure you all know that Pershing acts as custodian, so 7IM doesn't hold assets on behalf of clients, are all held at Pershing. They currently have a requirement to send statements annually, which are intended to be an independent demonstration to clients that what we say they've got actually does exist. And they too will be moving to quarterly. What we're trying to do with Pershing, so we think it will be helpful, is to get a sort of stamp on our valuations confirming that Pershing agree that that is actually held. That's something we're talking to them about now. We intend to talk to all Pershing's other clients. We know plenty of them quite well, and we will make a representation together to the regulator to say, will this satisfy the requirement? And we very much hope it will.
We hope so, because otherwise we're not only moving from 6 monthly to quarterly, we're moving from one statement to 2 statements. Right. Okay, more paper. Fantastic. Okay, talk me through costs and charges. What is happening here?
Okay. This is probably the area from a system development point of view that's causing us the most concern. And the reason for that is something no one who's ever met me has heard me say before, and no one will hear me say again. It's because the FCA rules are too short, or the draft rules, because say the rules aren't actually confirmed yet. The intention of the revisions to the cost and charges requirements are that investors should be in a position to compare like with like and to understand on a very granular basis how much the investments in the portfolio actually cost them. So that covers the whole range of charges. So in a fund it would be AMCs, OCF and the advisor charge that would be facilitated. But they can understand line by line how much each fund actually costs them to hold.
Okay, so what we're really getting at there is a lot more detail.
It's a lot more detail, but we're not quite clear exactly how much detail because, say, the rules are relatively short, which I say is generally a good thing, but not always.
So going back to our only 9 months until the MiFID party starts, when are we going to get this clarification?
I'd say the rules are due out by the end of June, but that gives us a very short timescale to develop systems if that's what we need to do, and we suspect it will be. In the meantime, there's at least 3 trade bodies that we're aware of, the Investment Association, TISA and the Wealth Management Association, who are talking to each other and to the regulator to try to establish a common template. Because if we bear in mind, as we said a moment ago, the intention is to allow the clients to compare like with like. They've got really little chance of doing that if every firm in the market comes up with a different version. That doesn't sound like a very constructive outcome to me. So we hope that there'll be some fruitful discussions between the trade bodies and the regulator.
Let's hope so. So we're hoping to get sort of an industry consensus.
I hope so.
Okay.
Yeah.
Now, moving on to the next one. Now, this is my favourite part of MiFID. This is a truly baffling part of MiFID. Am I allowed to say that? Well, I'm absolutely baffled by it. Can you talk us through what has to happen if a client's portfolio falls by 10% in a day?
To be fair, it doesn't matter if you're allowed to say that because you already have. So that ship has sailed. This is a really odd part of MiFID, and no one that I'm aware of really gets what the purpose is or how it's actually going to work in practice. But what needs to happen? We go back to portfolio evaluations that we just talked about at some length. So a client gets a quarterly portfolio evaluation as at the 31st of December for the sake of argument. If at any point between the 31st of December and the 31st of March that portfolio drops in value by more than 10%, then the current draft rule says the client must be informed the same day, which sounds very demanding to me. And more than just demanding, possibly counterproductive. I'm not sure all clients would appreciate a phone call or an email or whatever saying, dear Mr. Bloggs, your portfolio is going down 10%. And if you have to do it the same day, it's very demanding to put any context in that sort of message.
So we may as well just send an email saying panic.
I hesitate to endorse that approach, but I can see where it might come from.
Okay. So it's 10% across the whole portfolio, so it's not the individual holdings, so it's not an individual line of stock or ETF or a fund. Across the portfolio, do we need, so as a platform provider, do we need to report that directly to the client, or are we okay to report it to the client's advisor, who then will have to report it to the client?
I think we'd be absolutely fine to take the latter route, to go to the advisor, but of course the requirement is the same day, so if there's extra links in that particular chain, that's going to be very demanding. I wish I could propose a solution to this, but in all honesty, I'm scratching my head a little bit on that. I don't know what the solution is. And there are some other things to clarify in there as well. I'm not sure a portfolio is explicitly defined. Does that mean an ISA, or does it mean a client SIP, ISA and GIA and bond and anything else they have in there? Hopefully the latter. And the really demanding one, if we take a model portfolio as an example, there may be 10, 12 elements in that model portfolio. Some will be market listed, some may be authorised funds. And of course authorised funds price at very different points. Some price at 8 o'clock in the morning, some at midday, some have to close of business, and all points in between. So how we identify when that 10% fall has happened, I'm not entirely sure that's clear to anybody just yet.
Okay, so it sounds like there's a lot of challenges there. Dare I ask, do you think that this little part could be forgotten about and not be implemented?
There's certainly a very strong lobby trying to suggest that should happen. I'm not entirely sure I would put too much money on it being scrapped, because the problem with all European directives, of course, is that they have to be agreed by all the European regulators. So to go back, presumably all 28 or 28 now, soon to be one less anyway, they've all agreed on it and it's been published. So to go back and change it means going back to all those regulators and agreeing to change it again, which doesn't sound desperately likely to me.
But there's still a lot of lobbying going on, including lobbying from us.
Absolutely. We would lobby through trade associations rather than directly. I think that's the most constructive way to do it, but this is something that concerns. It seems a very minor element of MiFID, but potentially a quite demanding and worrying one.
And dare I say, it could actually cause more concern among clients, rather than a thank you for informing me response.
So. And there are other elements of this as well. Of course, there are two ways, I think, broadly, in which a portfolio could fall by 10%. One would be the gradual market slide, which could obviously happen at any point. And the other one is the rather more cataclysmic reason for something going down 10%. And what we tend to see on those occasions, of course, we've all seen plenty of those sort of incidents, is that quite often the market bounces back very quickly.
Is it something like a flash crash that happens in the morning, but by the afternoon everyone's thinking, what went on this morning?
Or some particular political incident, who knows, but markets do occasionally fall by 10% in a very short space of time.
Well, luckily there's not a lot going on in the political world.
No, it's often very stable at the moment.
Yeah,
so,
nothing to worry about there then. Okay, so let's move away from the reporting to the FCA and to the client and talk about what we actually need to do from a product governance point of view. So this is no longer us acting as a platform, this is us acting as 7IM, the fund manager, and we have a range of products.
Okay. There's two aspects to this and two slides, and this first one says, Verona says, is about the funds that 7IM produces as a fund manager. And there's not really anything very new in here. If we go back some years, there was a document published by the FCA which now forms an annex to their handbook called the Responsibilities of Product Providers and Distributors. By FCA standards, it's a very short read, and it really says you should understand who is buying your product, which is not an unreasonable starting point, I wouldn't have thought. But of course it's very demanding, because for us as a fund manager, we clearly don't know everybody that buys our product. If it's bought from another platform, all we see is a nominee name. We don't know who's behind that. We don't know if it's one holder or 100 holders, and it's very difficult to identify that the right people are buying it.
Okay, so this, in summary, this is something that 7IM and fund managers must do?
Yeah, absolutely.
No additional requirements onto advisors or their clients?
Not yet, but we'll move on to that in a moment.
Okay.
The way this is going to work, I think, and again, this is not radically new. The FCA wishes fund managers who produce funds to be very, very clear about what the purpose of that product is for and who it's suitable for, and by either implication or explicit information, what it's not suitable for. There are concepts out there such as a core solution, which might be a multi-asset fund, such as the, let me backtrack on that, a solution, which might be one of the 7IM multi-asset funds, which could theoretically be suitable for a client's majority of their portfolio. A core, which might be something like a FTSE tracker, which would form part of a portfolio, maybe one of the low-cost versions. Or a satellite or niche element, which could be, say, a commodity fund, that sort of thing. Something around the edges of a portfolio which you really wouldn't expect someone to put their entire fund into. I think where this stems from, the regulator is very concerned that sometimes product manufacturers develop products not because they see a need for them, but because they can see the chance of selling a lot of them. And there are enough examples of that in the past to see that the regulators, I think, have got a fair point. If you look back over history, things like technology funds in 2000 were launched more or less at the top of the market and fell off a cliff. Likewise, commercial property in 2007, early 2008, they didn't go especially well, but they took in a lot of retail money. I think probably the same thing to some degree in China funds 2-3 years ago, when a lot of these things were sold and they didn't really develop it as anyone would wish. So what the regulator is trying to achieve is that products are only launched when there is a need for them, not just because they can be sold. Okay,
so in a simple terminology, what the regulator is trying to do is to basically stop the fads.
I think that's I was going to call them a niche, but I prefer fads.
Yeah. Okay, fantastic. Right. So that's looking at us as a product provider. Flipping over and talk about third-party product governance, and this is specifically relevant for us as a platform.
Yeah, very much so. Obviously, there's a lot of fund groups have their funds on our platform, largely driven by advisor demand, so that they can invest in a wide range and open architecture approach as our platform provides. But all those product providers will be looking to 7IM for details of who is buying their funds, so that they can comply with this requirement to understand that they're hitting the right place. I guess the upshot of that for advisors is that you are much more likely to get a query from a fund manager as to what you're using a fund for, and they will want to be able to establish and document that you've understood the fund, you know what it's for, you know what the risks are, the benefits, etc., etc., and that therefore there is a good chance that it's going to go to the right end client.
Mm-hmm. So that's a requirement that's back on us as the platform provider to provide this additional information to the fund managers that distribute their funds through our platform.
Absolutely, and thankfully the regulator has here pulled back from some of the most demanding elements. There was some concepts which I thought everyone thought was unusual at the time, and I think the regulator has now agreed. Things like demographic concepts of you couldn't be selling lots of high-risk funds into, say, a poor area. I'm not quite sure how that would be defined or maintained, but that's thankfully has gone away. But what they will be looking for are anomalies, I would guess. Most product manufacturers who obviously talk to advisors and try to convince them of the merits of their product should have a reasonable understanding of the sort of market that those advisors are addressing. And therefore, if flows come into products or indeed out of products that just do not tally up with what they understand the advisor to be interested in, it's entirely likely that will generate a query. And I do stress the word query. It's not that they're going to say you're not allowed to do that because they're all regulated companies in this chain, but it is likely to raise more questions.
Okay, fantastic. So moving on to something that's a little bit similar, but something that does actually apply across the board: complex products and appropriateness.
Yeah, not a new concept. I think it dates from the original MiFID, so 10 years ago. It's not 100% clear yet what will be a complex product in the new world post 2017, so from January next year. A complex product will certainly include derivatives, some unregulated schemes, structured products, those sort of things. It doesn't include listed shares and authorised funds, but there are two very important categories here where clarity is still being sought. As the draft rules stand at the moment, clearly nurse funds and investment trusts will be classified as complex. And I think the sort of origin of that situation is that those products don't really exist in mainland Europe. Certainly the investment trust is, as far as I'm aware, a fairly uniquely British concept, a very old concept, but they don't really exist in mainland Europe in the same way that they do here. And therefore they're classified as complex, and obviously they have features which do add to complexity, things like portfolio gearing, that sort of thing. There is a lot of lobbying going on for interested parties, so both for investment trusts and nurse, and obviously there's some very large nurse out there, non-UCITS schemes.
Examples of that are a lot of the multi-manager products.
Yeah, a lot of ones that invest in things which are not eligible to go in a UCITS fund. So any fund that invests in actual property, bricks and mortar, rather than property investment trust, for example, they can't be UCITS schemes, but they can be nurse schemes. And these are things that the UK regulator said are suitable for the retail market. There's a clue in the name, non-UCITS retail scheme. But again, it's not really a European concept. UCITS is king over there. So my personal opinion is that the lobbying will be successful, but I'm going to stress that is a personal opinion. I don't know that for sure. But there is enough weight behind those lobbies to suggest that they might get some relaxation on those. I've been wrong before.
Okay, and just so that everybody knows, none of the 7IM funds will fall into the complex bucket.
No, all our funds, including the Dublin range, are all UCITS funds, so they are very definitely non-complex. And that makes life easier, because if people are buying on a non-advised or non-discretionary basis, those two areas being covered by suitability. But for execution-only transactions, the executor would have to ensure, and that's not a word I would use lightly, that investors understand the risks involved in an investment and the objectives, so that they're in a good position to make a sensible decision that it's the right thing for them. And in a lot of cases, that means people actually sitting almost an exam, an appropriateness test. I'm not entirely sure those can guarantee people understand the risks involved, but they do exist. There are plenty of them out there that, particularly on structured product providers, where people have to get through these things and essentially gain a pass mark before they're allowed to go any further.
And that's the end investor, not the advisor.
That is the end investor, yeah, because as we say, the advised and discretionary ones, suitability rules, and we're all very familiar with those, apply rather than appropriateness.
Fantastic. Okay, so summary there is that simple is actually a good thing to be, because complex will actually put more onerous on the advisor and the investor to actually agree that they understand the ins and the outs of the complex product.
Very much so.
Okay, we've got just some other areas that we wanted to touch on, and then we've had quite a few questions come in. So maybe if we quickly touch on these last areas, then we can get into the questions.
Okay. I was umming and ahhing a bit whether there should be 3 or 4 of these. I put 3 on them, but I'm going to talk briefly about 4. Had trouble making my mind up yesterday. Best execution sounds like a very simple concept to me. I would define it as getting the best price for the client in a traded security. Sadly, it's not quite that simple. There are 53 separate rules in the best execution element of the FCA handbook, which I've had the joy of going through line by line. They essentially add up to getting the best price for the client. There's a lot more detail than that. The real impact of MiFID is in transparency of policy. We have a best execution policy on our website at the moment, as all regulated firms should do that are active in the markets. It's not hugely detailed. There's a lot of sort of conceptual and principle stuff in there. It will become a lot more detailed, and that will be up on the website probably significantly before MiFID, because it's essentially what we do anyway. The other thing we were going to have to do is publish data, again via the website, on where we've executed business. We have to publish our top 5 execution venues, is the technical term, and that could mean in different circumstances different stock exchanges or different brokers using those stock exchanges. And I think we'll be taking the latter approach, but that will be published every quarter, so we can see that who we're actually doing business through.
So again, that's nothing for the advisor or their clients to worry about. That's all back on 7IM.
Yeah, just additional data. Whether anyone uses it, finds it useful, I couldn't possibly say, but it will be made available.
Fantastic.
And the second one was telephone recording. I've been at 7IM nearly 10 years, and we've recorded our phone calls throughout that period. They're very useful. We use them for any form of dispute resolution, and usually it's fairly clear. We can sort those things out very quickly. And we also use them quite extensively for training. I think in Alex's team they're used in their team meetings to see who's handled call particularly well. I imagine always particularly well, Alex, but I'll leave that to others.
Goes without saying.
Always good examples in there. They're used for lots of reasons, but we have no regulatory obligation at the moment to record those. That's just something we do as what we think is good business practice. And of course, for advisors at the moment, there is no requirement to record telephone lines. I'm sure some do and some don't, but there isn't a requirement. But as it stands at the moment, there will be a requirement, and the requirement says you must record all lines on which transactions are carried out or are likely to be carried out, or there's a reasonable possibility that they could be carried out. Now, clearly that doesn't include compliance. We don't do many transactions there, but I don't think I'm going to get my phone line off the recorded list. But it will mean a lot of phone calls need to be recorded. And of course, it's not just phone calls. The rules actually say any form of electronic communication. And I think they're deliberately written that way because who knows what's going to be invented tomorrow and the day after.
Okay. So this isn't a requirement just for us, it's also a requirement for advisors?
It is. Again, I believe it's not a lobby that we're party of, because obviously we're in a slightly different sector, but I think there is some lobbying going on to try to relax that rule, but I really couldn't comment on the chances of any sort of success.
Because it also includes mobiles as well?
It includes mobiles, and bearing in mind, say, any form of electronic communication. If anyone's in the habit of passing orders through text or WhatsApp or anything like that, I'm not entirely sure how you record those, so my recommendation here, people don't do it. I hope they don't do it already.
Okay, the last point that you've got up there is inducements. Now, I thought inducements, that fun had stopped.
Well, there are 2 types of inducements, and it's important to make the distinction. The gifts and hospitality one, I think we all know the FCA has had a major crackdown on that, and it's pretty much killed that for better or worse. It's a subject that's not really familiar to a compliance officer, because we don't get invited out very often by anyone, really. There have been some interesting stories in the press recently. I noticed one large firm who sponsors a very large floral event in West London has pulled out of that. It was reported in the papers they were pulling out as a result of Brexit. I have my doubts. I think it was pulled out of because it was just impossible for them to use in the way that they had been using it for many years. And also there's lots of examples of that. But probably more importantly, the sort of inducement that the regulator's particularly keen on, not that they're not keen on that one, is the sort of pay-to-play arrangements. And there's been plenty of discussion about those since RDR, which put a stop to many of those sort of arrangements and abuses, which were seen as creating bias. There is a list in the FCA handbook at the moment. It's called the Table of Non-Monetary Benefits, or Allowable Non-Monetary Benefits. And that allows firms to provide things like seminars, marketing material, those sort of support, which are considered reasonably to have a potential benefit for the end clients. And they're still allowed, but they have cracked down on them. We're in the state where we're having discussions about whether we can have high-quality sandwiches or ones from the Tesco Express around the corner, that sort of thing.
Tackling the big issues.
Tackling the big issues. So, yeah, I think people are a little bit worried about that, but clearly we want to support partners in the right way and make sure the clients are getting the right information, and that sort of arrangement does help that. Now, the one I've left off there, number 4, was suitability. which is everyone's favourite topic, certainly the regulators. And just to very briefly mention that, the rules don't really change, but they do go back to a formal annual requirement for suitability reviews. And when I was a regulator, which is over 20 years ago now, IMRO, for anyone who remembers that, it did appear in the IMRO handbook you had to do an annual review. That disappeared and it moved to appropriate frequency. It's going back to annual, which I think everyone knows is very demanding. And we'll have to try and find some clever ways of getting that data, because doing full-blown reviews of every client every year is a very demanding and time-consuming task. So that's a subject we'll come back to. Great.
Now, we've had quite a few questions, so why don't I just quickly go through some of these questions. Oh, this is my favourite. How will Brexit impact MiFID II? We're leaving, right? So...
yeah, we can forget it. I think we've just wasted an hour of our Thursday morning, unfortunately. Unfortunately, I don't think it will affect it at all. Financial services in the UK is clearly a very important sector. A lot of the financial services companies that are based in London or have offices in London transact business throughout Europe. And if they don't stick to the European rules, the chance of them transacting business in Europe in the future would be nil. So even though a lot of domestic firms have very limited business in Europe, including 7IM, they're not about to write two sets of rules for those who have cross-border business and those who don't. So I don't think it'll affect it at all, sadly, is the answer to that one.
So MiFID is here to stay?
I'm afraid so.
Okay. Back to the LEIs. A question here. After year one, who will be responsible for ensuring the LEI has been renewed?
Well, ultimately, the person who owns the LEI, which is the entity itself, so the trust, corporate, charity. As we said, if people have authority to update them, and I would suggest if they get authority to apply for one of these codes from a client, it would be wise for that authority to say, and until further notice, or words to that effect, because they have to be reviewed by whoever's got the authority, but ultimately the legal entity involved.
Okay, so it comes down to them. Are trustee accounts personal or non-personal?
I think there's two answers to that. Certainly things like bear trusts would be personal accounts. I don't think formal trusts which have a deed would be personal. There's a real strange quirk here, because my legal friends who sit very close to me tell me that a trust is not a legal entity, but it's absolutely clear from the regulation that despite that it needs to get a legal entity identifier. I suspect that's because of, I'm not aware that the European trust market is similar to the UK, but that's not a point of huge expertise.
Okay, so really the aim of the game here is that whether you're a personal account or a non-personal account, there needs to be some identifier.
Yeah, and I don't think a national insurance number for, say, a lead trustee, if there is such a thing, would cut the mustard on that one.
Okay, and that rolls into the next question quite well. What is the position with clients outside the UK where they don't have a national insurance number?
We have to do something called a concatenation, which is not a word I use often, even in compliance. That's a lengthy one. That largely involves a passport number and a code for the nationality. So there are alternatives. Clearly, we would prefer to use a national insurance number whenever it's available.
Okay, so it comes back to being able to identify the individual.
Yeah.
Okay. The extra transaction reporting requirements. Really good question, actually. David and I were speaking about this before. Why do these extra transaction reporting requirements only cover ETFs and listed securities and not the underlying funds?
I think there's a reasonably simple but probably quite lengthy answer to that. We're looking really at market abuse. That's the purpose of these rules, is not to market abuse, to stop it.
Not to encourage market abuse.
It's not a good thing. And authorised funds are not listed on markets. It would be quite hard to abuse a multi-asset fund, for example, because you have inside information, because all the individual elements are likely to be quoted on a market and have their own price, which goes into calculating the net asset value. So I don't think there'll be a lot to be gained by the regulator from seeing who's been taking advantage of information to get a better price for their fund.
Okay.
Of course, the actual transactions which are undertaken by the fund, they're not technically subject to transaction reporting. That's quite a long subject, but the regulator is aware of those transactions that underlie the fund itself.
Okay, so that does then make sense in a roundabout kind of way. The regulator's main concern is looking for people that can abuse the market, and the only way to really abuse that is on the open market.
Yeah, so if a fund is priced at NAV, there's not really a lot of scope to abuse that, but clearly if you know that the price that should apply to a security is not the one in the market because of information you have the chance to take advantage of that, and that's what they're trying to stop.
Okay. Oh, this is a question on my favourite one, the 10% fall. Yeah. So we've got quite a few questions here. 10% fall. Who has to report it? So I think that came back to who actually has to tell the client. Mm-hmm. And from us as a platform, I think we mentioned we could tell the advisor who tells the client. So we don't need to report that to the FCA. No. That's reporting it to the client. Yes,
it's purely a client manager stroke advisor requirement. It's providing this information to the client. So the regulator's not involved in that at all, other than probably checking that it's been done.
Okay. The 10% fall, that's since the last valuation date. So I think you mentioned if the valuation date was, say, the 31st of December, anything that happens in the next 3 months.
Yeah. Should probably just expand on that a little. This is my current understanding, and so this is subject to change possibly. It applies to the valuation at the end of the reporting period, and then if it falls 10%, it would then reset to that new level at 10%. So if it fell 10% by the end of January and another 10% by the end of February, you'd be reporting twice.
Okay, so it's actually not falling 10% in a day. It's falling 10% over the time period since the last reporting.
That's right. The day concept is a reporting period, not the...
Yes. It has to be reported on the day when the 10% drop has happened over since the last valuation statement.
I think we can safely say this is the area that we're hoping for movement on, but not quite guaranteeing it.
Yes. Another question on this, does it take into account withdrawals, or will be taking that into account? So if someone does withdraw, we'll know that's a withdrawal and not a market movement.
That is my belief. I can't put any more strongly than that. But of course, that it does give system demands to make sure that's recognisable.
Okay, moving away from the 10% fall onto the recording of things. If firms use video conferencing, do you think the regulator will accept the video only being recorded?
As opposed to the words spoken?
No, as opposed to the visual.
Yes, I would think so, because they're looking for the key elements, and the key elements are who decided to do what when.
Yeah, so you're only recording audio, not visual.
Yeah, I don't think the FCA is about to employ body language specialists to solve market abuse, but let's not suggest that.
Yes. Okay, question now on to discretionary managers. Do we as advisors / discretionary managers have to publish execution venues, or is this only the responsibility of 7IM?
It's the actual executor in the market, so whoever's closest to the market, which I think in this case will be 7IM.
In all cases, if you're using 7IM, it will be 7IM.
Yeah, the purpose of that being they're essentially looking to see that firms are trawling the market effectively to get the best price for the client, and if that's not under the control of a discretionary manager who's passing orders to a platform such as ours, then that clearly couldn't apply to that element of the chain.
So this really applies to our dealing desk, which all our deals go through to get to market. Okay. Next question, is there a need for IFAs to change their permissions?
Potentially. There are some areas of business which are not regulated at the moment that are coming under the FCA scope. They are fairly esoteric areas. For example, there's quite a few farmers are going to have to seek regulation because they trade in commodity derivatives to get a good price for their wheat. I don't think many IFAs will be in that market, but I may be wrong. I think potentially. I think it's unlikely in most cases. What the most impact of this in terms of authorisations is firms that are not authorised at the moment and will need to seek authorisation. I think it's unlikely that any firm that's conducting relatively normal, for want of a better word, business will need to do anything additional. But clearly individual firms would have to establish that themselves.
Fantastic. Okay, that's all the questions that we've had through, but please, if you do have more questions, please email them through. We have our MiFID contacts. If you email it into that mifid@7im.co.uk, we will absolutely turn that question round. All of these questions and the answers we'll be putting on our website, a special page on our website, which contains all the MiFID content and information. We'll also be putting this webinar recording up there as well. As I said, we do really want to encourage you to ask us the questions. Once we start needing things, things, such as the LEI numbers and different things, we will definitely come back and ask you, and we'll be able to actually go to you and say, for these particular clients, this is what we need, whether that's a national insurance number or an LEI number.
One or two other very minor points. We were looking for all our advisor relationships for a single point of contact if that's appropriate. We've got a lot of those, but not 100%. So if anyone wishes to send us their contact details to the email address that's on the screen, we know that when we ask the questions that we need back, we'll be going to the right place. So that will be helpful for everybody.
Fantastic. So sounds like a lot to cover in MiFID, a lot for us all to do in the next 9 months. Our aim here, though, is to make it as pain-free as possible for us and for you, and most importantly for your clients. Hence the reason we want to have this open dialogue, and we'll be doing more of these MiFID webinars as more clarification is received either by the regulator and how we'll be actually addressing each of these things that we need to do.
Yeah, absolutely.
Fantastic. Thank you for dialing in. I'm going to hand back over to Alex.
Okay, well, thank you very much for your attendance today. Hopefully that cleared up the vast majority of questions that you might have had at this stage. A quick note that the slides and the full webinar will be sent out 24 hours after we finish today. So you'll receive that in your inboxes by around about this time tomorrow morning. If you do have any questions that weren't answered, then please do contact your local BDM and we'll do our best to answer any questions that you might have. But that's all from us. Thank you very much for dialing in.
Yes, thank you.
Thank you very much. Thank you.